Alright, so there's a move setting up. This is the hero. Basically, it's a higher time frame. To make it really simple, it went from cause to its effect by like one or two boxes. Then it rallied and it got stuck in this range. Now, I don't know what this range is. I thought maybe it could be anything, because the market started breaking out above this resistance area. But the second level of resistance, it stopped once, twice, three, four times, and selling came here, and it couldn't break out. Okay, so this range, I mean, this is my opinion. Like, I think it can go down some more. Anyway, so we basically was in markdown, and it rallied to the higher resistance up here, this up thrust area, and it started moving sideways. Okay, so I have to go to lower time frames to start figuring out what's going on. And on the lower time frame, you see this arrow right there, arrow right there. I really like this because this was the rally. It was a sign of strength, a low volume pullback, and confirmation of an uptrend. Pulled back, made a hinge, rallied 35,000 volume, could not get above 15,000. That's significant. Why? Because it's double the volume, couldn't get above. So there's some type of effort reward. And it went all the way back down to test. Then it rallied on 23, pulled back on 8, came up on 8. It couldn't break out. Okay? It couldn't break out. So what did it do? It went back to the same area. But this time, when it went back to that same area, it went down on this much volume. So low volume up, as indicated by the LV indicator, and high volume down. That's low volume demand is weak and high volume supply is strong. That's the way I'm interpreting it. And this is not pullback volume at all. So you can see very clearly that these guys came and just said, we're going to block it, smash it back down. It went right back down. And this also looks like an upthrust, like failed breakouts up here. Then it moved up on 15, 15, 23. Here it is. What the hell is it? So the way I'm reading it is this sign of weakness. This is your effort reward right here. 15 is your low volume pullback. Low volume pullback has to be quite low, relatively speaking. So 43,000 down, 15,000 up. That's pretty low. So almost one third. So you have your sign of weakness, low volume pullback again, and then effort right here. Now, the one thing I don't like is I'm not sure if a climax has occurred or, if this qualifies as some type of exhaustion. That I don't like because I want a climax because I want to see like rally, 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 and then, buyers get exhausted. Because what happens is if you don't have that and you have this type of movement, it becomes very random because there are always buyers that are stuck or buyers that want to get in, in this area right here where you have a low risk trade. They're there. So that's why I have to be a little bit careful and just thoughtful about what the hell is going on. So anyway, so low volume up, lack of demand, high volume selling, low volume pullback, low volume pullback. There's your effort. Okay, now what else I want to do is and I'll explain what I'm doing later. But here's the thing. Now I want to see what's going on here on an even microscopic level, and that's what I was saying I was going to do yesterday. Is right here. You see this area right here, this block is this F for reward. So let's take a look at what happened. It went up to that area and got smashed down, and then it went up and we started moving sideways, and now it's falling. I have this type of formation looks very much like what's known as springboard. Okay, springboard. They're different types, but this, in my opinion, qualifies, especially when you have selling and then like weak rallies or whatever. So that's this type of behavior. You have that. So I'm gonna see this, and I think this is a springboard on a microscopic level on a short time frame. You have that breakout, you have the rally test, and demand is not there. It's spent. So this is in like some type of springboard formation. It's my opinion, and it can be really beneficial. Um, springboard, which is different than spring. So that formation is coming right here at that potential effort reward, which I think that's what it is. Because 23,000, look, you can see the green wave and you see the other green wave. There's more volume, yet more volume here than the prior wave, but it's not going up. Why? Because they're selling on the other side. They're selling. Whoever's buying the other side is selling into that buying. So that's what I'm viewing. And the way I view this is the new trend is right there. And here you go. Sell, heavy, low volume pullback, low volume pullback, effort reward, meaning they try, no demand, try, no demand, try hard and still can't get it to continue. So now the bears come in, and I think they're really going to do a number on this market and break it at least to the low, like around here somewhere, if not lower. I'm getting that. I'm getting that impression. Again, this is for educational uses only and part of my trend review. So please don't go and just copy stuff. So that's what's going on. The second thing I want to talk about is something that learned the really hard way, which is if you when the process of trading, the process of the trading, that's what you have to get right. And it really needs to be a judgmental process. It's not like, okay, A, B, C, D in a mechanical way. It has to be a judgmental process. So the way Wyckoff did it with stocks was he first saw the market, right? What's the trend of the market? Then he said, let me take a look at the sectors. Then he saw which sectors are moving in line with the market. Then he sometimes he went go further into the industry groups to see which ones are in line with the market, and then he would see which one go the fastest, the furthest. He did that by seeing how much of a pullback there was when the market was down. Was this industry group going down, or was it holding? Was it bag holding? Then he took it a step further and took a look at the length of the base. All right, and he said, okay, this one has a lot of potential. This is one of the one I'm going to go into. He did that with the groups as well as the individual stock within the group. So that process of judging market, sector, group, individual stock, knowing the potential of it, the potential for cause and effect to see how far it can go, knowing whether it's in line with the market, knowing whether the group is strong or not. And by strong, I mean not just relative strength. I mean, like, yeah, I guess you could call it relative strength, but basically whether there's bag holding, meaning it's not falling down as the market is falling down. So he went through that judgmental process of market, group, sector, group, stock, and that whole thing, that is extremely important. Okay, going through that particular process is important. Now, let's say you're trading the futures, or I don't know, forex. So what you do is the higher time frame, um, trend, what also its behavior, meaning is it in breaking, is it a test, is it at support resistance, knowing its cause and effect, and going to lower time frame, so on and so forth, and then taking a step further. Basically, what I just did with the euro. So going through that process is what's critical, because if you don't go through that process, you will get a lot of random outcomes. Okay, you will get a lot of random outcomes. Why? Because if, let's say, for example, common one is a bull flag. So if you see a bull flag, the bull flag head and shoulder all over the place. So there has to be a judgmental process to come to the conclusion that this is a valid or highly likely bull flag if there, for example, is a climax before it, a secondary test, and that bull flag is part of a strong rally, and then the pullback is on low volume, and now it's in position, it's basing out, there's a hinge, there's a thrust coming, all of that is what makes something more likely. Otherwise, without that, the market creates too many formations, and that is its strength. It constantly um, changes in ways and in volatility and all of that, and requires you to adapt. And indicators and all that, they cannot adapt. That's their weakness. All indicators are rule based. If this, then that. They're all rule based. They cannot adapt. Okay? They cannot adapt, and they are rigid, meaning they're forced by a set of rules. Okay? They cannot be creative. They have to be mathematical. They cannot be creative, and they're always following set of rules that does not allow. That is basically very mechanical and has no thinking. It's just if then, if then, if then. So this weakness makes them unable to judge market behavior. Indicator cannot judge direction. They just can't. All they can do is, and I said it before, is give facts. If you figure that out and their lack of ability to adapt, you'll know why a judgmental process is required. And then you'll realize that all the indicators that are sold are bullshit. Anyway, thank you very much. Have a good day. Bye.